I want to put this question to you because a number of reasons have been put forward, right, for this weak bid-to-cover ratio. Chinese demand, the level of the yield, low yields, also concerns about US debt and borrowing, but then, of course, the hedging of foreign investors, perhaps making treasuries less attractive as well. How worried are you by bid-to-cover ratio that's the weakest since 2009? I think it's a bunch of reasons that you just cited that led to this particular outcome. I think generally I'd probably come down somewhere between Jamie Dimon and Mr. Eisman. I think the yields seem a little low given the resilience of the economy. We've got unemployment at 40 or 50-year lows. We've got pretty good corporate earnings right now. The markets, in spite of what's happened in the last 48 hours, are pretty strong. So I think it's wrong to put too much meaning into a single Treasury auction like that, even though it's part of the larger narrative we have to watch.
Christopher, do you think that yields are appropriate given the inflation, the lack of, let's say, explosion in inflation on the upside?
You know, the market is always right, but I think if I were the market, I would look more at the underlying data. Well, exactly. But I think the underlying data would suggest that yields are lower than they probably ought to be at this stage. I think, again, we have seen with each sell-off, we have seen data continuing to come through on the strength of the household sector, particularly in the U.S., the corporate sector, I say again. And I think, again, the recovery in China has been slowing, but it is responding to the tools that the government has deployed. And, I think it printed a pretty good GDP number last week. And, I think the outlook is much better than investors or bond investors are pricing in right now. Yeah, and at Barings Investment Institute, of course, you take a very long-term view. So if some of these concerns go away, at least for now, say the trade war doesn't escalate to the worst possible level of more tariffs, and then they stop talking to each other, and the market starts looking at the Fed a little bit differently, they start getting a little bit more hawkish, the Fed does, that is. How at Barings would you prepare for a significant repricing in the bond market? How realistic is that? Well, I think a significant repricing is always possible, but hard to predict. And I think we look at things as you go into the next cycle. This cycle will end at some point. I don't think it's anytime soon. But if you look at a longer-term time horizon, I think it's important to keep in mind how the next cycle is going to be different from this one. In one sense, it's the fact that we have central banks who are with us to stay, and they are not going away. Their quantitative easing is pulled back slightly, but it's hard for them to withdraw entirely from the economy, and that's going to create a whole new investment space for markets to have to consider. Second big change, I think, is going to be technology. The digitization of our world, the change in business models is significant. And then lastly, of course, is politics and populism, where tariffs are now, I think, a permanent feature, or the threat of tariffs are a permanent feature in our world.